Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Bill Davis, founding partner at Stance Capital. Bill, it's great to see you again. Welcome back to Trade Talks.
Hey, thanks, Jill. Good to see you again as well.
Let's talk about ESG. It seems to be everywhere these days, but also seems to lack definition. What is your take on this, and where does Stance fit in?
Well, to a certain degree, I think it's sort of expected that it's going to lack a bit of definition, and I say that because ESG is a form of values-aligned investing. It's an opportunity for investors to decide that they want to align their capital with whatever their values happen to be. And so it sort of stands to reason that not everybody has the same set of values. Therefore, there are going to be different interpretations of ESG, and I think that's actually a good thing. I mean, that's sort of the idea. Having said that, I would also say that there is somewhat of an authenticity issue in the industry where I think that there's a lot of product that is ESG aware or is simply, an old product that has been reskinned as ESG. And I would say that's not a particularly good thing for the industry. However, I do believe that investors ultimately will sort this out. I think that as they become more comfortable with this idea that you can align capital with values without underperforming the market, they will become more discerning in terms of what they're looking for, and they will look a little harder at the things that maybe they're invested in and see that it either does or doesn't meet their needs. At Stance, I think our approach to all of this is to, well, first of all, we were purpose-built around ESG, so we're not retrofitting this onto a different framework. But we believe that ESG is dynamic, because companies are being more transparent and they're actually starting to disclose data elements that they never used to disclose, some of which can rise to the level of material risk factors. And so we have had a robust, consistent, yet dynamic methodology from day one in this space.
So given the global focus on carbon reduction, how does Stance Capital incorporate carbon reduction information into portfolio construction?
Sure, really good question. And actually, right before I answer that question, I want to say something about carbon reduction as a whole. If you look at most ESG strategies in the marketplace today, many of them are, in my view, simply a proxy for mega cap tech and comm services portfolios. And there's really nothing wrong with that, but let's call them what they are, which are sector bets. And so I think many ESG investors are deeply concerned about climate risk, and they should be. I mean, the western half of the US is on fire, facing record heat waves. Other parts of the world are having massive floods and basically climate-related destruction, which is just increasing each and every year. So I think investors are rightly concerned about climate risk. And so the problem with purely a growth-oriented ESG strategy, if the companies you're investing in don't have a carbon problem to begin with, then you're not solving the problems of climate risk by investing in purely in those companies. And so that is, I think, sort of sets up, I think, our answer to this question, which is that we believe that there are no sectors of the economy that are going to go away as a result of climate risk. It's just that there are going to be leaders and laggards, there's going to be winners and there's going to be losers. And so for investors who are using ESG as a lens through which they can apply to all asset classes, meaning that if they're a large cap ESG investor, they should want to invest in as many segments of the economy as possible. Stance's point of view is to identify those companies who are leading from a carbon standpoint and those who are lagging or in many ways just simply not accepting that this is real, and really making sure that we're investing in good companies and avoiding bad companies, and we're trying to do it across as many sectors of the economy as possible.
Does ESG in and of itself generate better returns, or is it more about something else?
Really good question, Jill. I think that depending on the portfolio, it can be a lot of different things. I would say in our case, and we now have a 7.5-year track record investing in ESG large cap core. I think our view is that it is primarily a framework for managing risk. I mean, I think that there is this tailwind that comes with investing in good ESG companies, with lots of other ESG firms recognizing that they are good companies and really sort of lifting those companies forward. But I think that's really not what this is about. I mean, this to me is more about identifying material risks which happen to be off balance sheet. So perhaps traditional fundamental investors aren't necessarily looking at these risks, and incorporating them into our portfolio. Now, having said that, we also place significant emphasis on risk controls that have actually nothing to do with ESG, just through the manner in which we look at risk efficiency and optimization. But I would say fundamentally, and especially in the wake of climate risk, this really is about managing risk. And I'll give you one example, actually, which directly relates to climate, and that is COVID. And not everybody thinks of COVID as climate related, but we certainly do. And in the, after Q1 of 2020, when obviously the market was down, I think 19.6%, Stance did actually very well relative to the market because of our risk controls. But one of the things we asked ourselves afterwards was, are there ways in the wake of climate risk and global pandemics that we can build portfolios that are even more resilient? And one of the things that we looked at, which was not a material risk factor we were tracking, by the way, at the time, and I don't think very many, if anybody else was either, is paid sick leave. Because in many industry groups, it's not an issue because employees are paid adequately and they have ample sick leave. But there are some industries, and I'll use one as an example, the meatpacking industry, which historically has not offered paid sick leave, number one. And number two, tends to be low-paying jobs, so that the first thing that somebody's going to do when they, let's say, contract COVID is going to go back to work, because they have to go back to work because they have to feed their family. And ultimately, that poses financial risk for investors, because if facilities get shut down and production stops, then obviously that affects financial performance. And so we actually began to build risk factors for certain industry groups around paid sick leave after Q1 of last year. And I think that's an example of where ESG is actually really strong, or has the potential to be really strong in implementing non-traditional risk controls.
All right, Bill, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.